Good afternoon. Very warm welcome to the next session of the Green Horizon Summit at COP26. My name's Catherine Howarth. I'm the Chief Executive of ShareAction, and I'm going to be speaking with a fantastic panel over the next 40 minutes on how to manage some of the financial risks that arise from the energy revolution as it unfolds. And we'll tackle specifically how to handle some of the implications of retiring fossil fuel assets on a timetable consistent with 1.5 degrees. Yesterday saw the full unveiling of the Glasgow Financial Alliance for Net Zero. Banks, asset managers, pension funds, insurers, all committing to financial decision-making and portfolio construction that aligns with 1.5 degrees. Of course, that was immediately met with a bit of a barrage of tough questions about how that's going to be achieved, and evidence produced, excellent piece in the FT yesterday, of specific recent financing decisions that appear entirely inconsistent with that goal and those commitments. So the question for leaders in financial institutions and indeed financial policymakers is, how do we get there? How do we get to 1.5 with the least disruption, instability and financial loss? And I'm going to just introduce my panel. Actually, I'm going to introduce them as each of them I invite to join in the discussion. So I'm going to start with Lord Adair Turner, whose pretty extraordinary CV gives him multiple perspectives through which to assess these transition challenges. But I think primarily as chair of the Energy Transition Commission, he's been thinking about these issues for a long time. Adair, you've been working on these for years. You can't but be impressed by the momentum and the commitments. But pledges are the easy bit. Tell us what you see as the biggest outstanding barriers to achieving the pace and scale of energy transition to keep the dream of 1.5 alive.
Well, thank you, Catherine. I mean, it's very difficult to set out one or two barriers, but we know what we need to do to build a zero carbon economy. We have got to deeply electrify the economy, probably take final energy demand, which we use in the terms of electricity, from 20% to 65%, produce much, much more clean energy. We've got to create a green hydrogen economy as well. And then we've got to do some biofuels and some carbon capture and storage. But the absolute core is electrification and green hydrogen. What we've also got to do is create the base of that electricity and green hydrogen and then use it in sectors. And the sectors also have got to transition. Shipping has to transition, moving to ammonia-based shipping. Steel has to transition, moving to a zero-carbon steel. And I actually was given yesterday one of the first little blocks of 500 grams of zero-carbon steel made from hydrogen direct reduction, not from coking coal. So there are these huge transitions going to occur. And what they then create in the financial sector is a series of different things that we have to finance. What one should think about is order of magnitude, $1.5 trillion a year, on average, over the next 30 years, has got to go into fundamentally building a massively bigger electricity system which is entirely zero carbon. And that means generation and transmission and distribution. And most of the investments there will be infrastructure investments. They'll be relatively safe, relatively moderate to low return assets, but still a damn sight better than putting your money in government bonds. Alongside that, we need finance to help the steel sector transition, the shipping sector transition. And there we need financial institutions to commit to they are only going to finance companies in transition. It's a tricky thing to work out because you can't measure it by their carbon emissions today. You've got to work out, what is this guy's strategy, this steel company, this shipping company, this aviation company? Have they got a credible path down to net zero, and is therefore one you want to back? In order of magnitude terms, this is more like 100 billion a year, not 1.5 trillion a year, but it's very important. And then finally, there is a huge opportunity, but this is more in the venture capital space than the banking or asset management space, for the new technology technologies which were needed, the next generation of batteries, the next generation of ever cheaper electrolyzers, and that will be the high risk, high return end of the opportunities here. So I'm afraid I haven't answered your question, Catherine, and said what is the single thing. What we need is the finance industry to realize how big is required, but I do think one of the things we need to do is break it down in the way that we've had. Sometimes we talk about these big figures overall, but for individual financial players, you've got to work out what does it mean for the infrastructure investor? What does it mean for the venture capital investment? What does it mean for the banker or the guy that's backing in the public equity markets, the shipping companies, the steel companies, the cement companies of the world?
We're doing quite a bit of work at ShareAction at the moment on the chemical sector, which has been a bit neglected actually in this debate. And there's a sector that the technologies needed are still quite nascent. But what we need is kind of institutional long-term holders of chemical stocks really supporting bold transition plans. But of course, the signals and incentives in capital markets are still quite short-term a lot of the time. And so what we're asking institutional investors to do is kind of operate in a rather new way in some way. What's your sense of how we get the kind of right balance of public policy, new incentives and thinking in the investment community, and the right incentives actually on corporate boards and management teams of tricky, hard-to-abate sectors like chemicals?
I don't know whether you were deliberately asking the most difficult question, but I actually think chemicals is the most difficult one to answer. I think if you go to steel, we know the technologies that will get to net zero. They heavily involve hydrogen. Pathways are being set out. With shipping, long-distance shipping, it's either methanol or ammonia. You can narrow the problem down to, are the ports going to have the ammonia facilities? Are the ships going to be built? Cement, we know the answer. The point about chemicals is, of course, it isn't one industry. It's lots of different things. You've got to break it aside. First of all, there's an ammonia stream, which goes into fertilizer. That is somewhat easier to understand. That is all about making sure that the hydrogen that goes into your ammonia is zero carbon to start with. Relatively simple to start talking about what is a good transition there. When you move over to the whole of the plastics and all the other chemicals, the petrochemicals, it is a more complicated space. This is going to be the area which continues to absorb, I think, oil and gas for longer than transport, where I think we will see an accelerated transformation faster than a lot of people are currently anticipating. In that chemical sector, there are new technologies, there are new ways of using hydrogen, different forces of carbon. I mean, at the essence, it's playing around with hydrogen atoms and carbon atoms. So the crucial issue is where you're getting your hydrogen from, where you're getting your carbon from. There is also a hugely important area there for recycling and the demand side. So we ought to be planning that the plastic sector, that a very significant part of our future demand for plastics is recycled. And what that tells us, and we keep finding this across different areas of the economy, but even more in chemicals than elsewhere, you need the corporates committed to develop net zero pathways. You need financiers who are only willing to finance net zero pathways, but sometimes you need regulation as well. We need tight regulation on the recycling. We also need carbon taxes. You simply need to increase the cost of inputs which come in carbon from fossil fuels rather than carbon from bio or carbon taken out of the atmosphere by direct air capture. So in chemicals, as elsewhere, but with greater complexity, it will have to be a combination of voluntary and encouraged financial and corporate action, but also strong regulation as well.
That regulation obviously helps to create a level playing field, which is what's needed. So another just follow-up question. Larry Fink talked earlier this week about the risks of fossil fuel assets shifting out of publicly traded firms into private firms where scrutiny, public scrutiny, and also where commitments around net zero are vastly lower. How do we tackle that challenge?
Well, I think Larry Fink was right on this. I mean, suppose you have a company that has a coal asset, right? And right today, you can't stop producing that coal. It's going into a coal plant which exists today, and somebody's electricity is dependent on it. But what we want is a clear plan that within 10 or 15 years, that asset is closed. Are you more likely to get that if it resides within a public listed company which has a net zero strategy? Or do you make it easy for that company's board to say, oh, I've divested it, and magically I'm close to net zero already. But what they've divested it to is a private equity player, maybe, who is or has no intention whatsoever of closing it down in 15 years' time. So I do think we've got to be careful of this, that divestment solves the problem. Divestment doesn't solve the problem. What solves the problem is closing the coal mine and the coal plant down. So you've got to come back to what are the strategies that result in those coal plants and those coal mines closing sooner rather than later. And I'm not convinced that divestment is a primary route to that.
So one of the solutions people are talking about are sort of bad banks that pick up some of those high carbon assets and have some kind of a mandate to wind them down, ideally on an accelerated timeframe. But there's a lot of questions around whether that produces moral hazard and who ends up really paying the cost. Is it just offloading? Old liabilities onto people that, onto the public. So what are your thoughts on the bad bank idea?
Well, I think some good ideas are emerging here. There's a major initiative around the Asia Development Bank and also various private banks where the construction is to go to existing operators of coal electricity plants throughout Asia, some of whom have PPAs, power purchase agreements lasting 15 or 20 years. And so the challenge here is that even when it gets to the point where renewables are cheaper than building or running that plant, because they've got a PPA at a fixed price set in advance, they're not going to close it down. So the vision is for the ADB, the Asian Development Bank, private finance, to step into that with a clear plan that this will be closed down sooner than it otherwise would. And you are buying out some existing people. The moral hazard, you've got to make absolutely clear. You should never do any of these deals in a country which is not already committed to no new coal. Right? You've got to have a no new coal commitment, because otherwise the danger is you're just buying out something there and somebody's taking the money, thank you very much, and I'll build a new one here. So these options should not be available to countries which have not made categoric no new coal commitments. But if you've got a country which has a categoric no new coal commitment, I think this could be a way to help us in particular close down existing coal before the end of useful life. We think that wind and solar, sometimes combined with batteries, are now cheaper than running existing coal plants. And they're cheaper even on what's called round-the-clock renewables. We're seeing some auctions of round-the-clock renewables which are blasting below the price of new coal. But renewables where there's an existing coal plant are competing either with the marginal cost of running that or with an already existing legal PPA. So we have to find a way around that. And I think that variant of what you might call a bad bank strategy is something we should explore.
OK, well, look, that's a fantastic segue into talking to Stuart Ball. Hi, Stuart. Stuart's Senior Vice President and Head of Natural Resources and Energy at the Bank of China. Stuart, China is one of the 3 or 4 economies in the world whose actions are make or break for the world's hopes of achieving the Paris goals. Can you start by telling us briefly about the state of green finance in China and the extent of engagement with the energy transition in your sector?
Yeah, no, certainly. Thank you. I mean, on the China thing, we've recently, the government as well as the Bank of China itself has recently announced its coal plan with regards to non-investment in new coal, which is a welcome step and a welcome statement. Secondly, there is the part of the 14th five-year plan. There is a 1 trillion RMB investment in domestic renewable activities, and a plan from the bank to actually move its assets to maybe 5% and hopefully a target of 10% invested in the renewable and the transition space. So the bank is very keen to be involved in it and sees that its future is very much wedded to this whole transition journey. And I think many banks that want to still be here in years to come recognise the importance of that partnership going forward. In terms of the engagement, locally, building out the balance sheet as you expect, building out the connections with the clients. But I think it does come back to there's a strong willingness to be able to participate and be party to the journey. But I think as only in the earlier presentation was met, we're willing and ready to invest in assets. We just need assets that have a plan. And we're keen to invest with both existing partners and new partners in that journey for, as Adair says, the key part of electrification.
So for your bank, for the Bank of China, what are you doing to anticipate and manage the financial risks associated with the energy transition? What does that look like in 2021? And what do you think that might start to look like in, let's say, 2025?
So I think it's very much wedded to the goals and aspirations that the planet Earth has in terms of reaching its net zero goals. In terms of Bank of China itself, and for a number of banks, it has financed and it is financing resource consumption for its home market. And it has to recognise that it has to transition both its domestic demand requirements, but also into the commercial banking sector, how it finances that as well, and what it is financed with. And that does actually mean looking at its balance sheet that it has and recognising that the partners it's with, it needs to identify whether or not they have the journey that allows the bank to be part of that solution between now, 2030, 2050 and 2060.
And Adair was talking about, all the high carbon sectors, the high energy using sectors, the hard to abate sectors. I mean, I know you're involved, you're mainly working with sort of natural resources and energy, but can you speak a bit to the role that your bank and banks in China are playing in kind of really working with clients to really support that kind of more ambitious strategy? I mean, my organisation, ShareAction, has been heavily involved in sort of assessing and ranking European banks on their engagement with the transition. And we are calling on, along with a lot of institutional investors, banks to be really on the front foot, really playing a kind of actually very proactive role in supporting and activating transition plans. And whilst institutional investors in those industries can play that role as well, there's kind of no one with a more intimate financing relationship than a bank to kind of work with firms and really help build capacity in a lot of cases for understanding, embracing the new technologies, taking the risks that are necessary to get us on the pathway at the pace we need. What does the banking sector see as its sort of role and responsibility supporting accelerated transition in the high energy using parts of the Chinese economy?
Domestic. Sometimes there's a bit of a juxta. So everybody is very keen to participate, be at the forefront, to lead. But as a commercial bank, sometimes you're also reliant upon the companies that you work with, because it's them that have the technology, that have the assets that need funding. So it's accelerating the debate that you have with that client in terms of identifying that they are the ones that you want to work for, and with time having the honest discussion as to which clients you're not going to work with. That conversation probably has, and those decisions are probably not at the forefront at the moment. The decisions very much are looking at who you're working with, but also who you need to be working with to be able to be at that forefront. But recognizing that actually it's the clients that you have that are going to be driving this, because they have the technology and the experiences. And yes, we have the capital, but we need them almost to help us to find the right places to deploy it. Very keen, as a bank, we're very keen to be involved in more and as much as we can in terms of transitioning ourselves as a balance sheet and to still be a viable commercial banking partner for the future.
I mean, could you imagine expecting and asking clients to publish transition plans as a kind of quid pro quo for having finance from your bank?
So I think, would we demand it? I think it would become part of the conversation. I think maybe it might be sometimes difficult for the banks to be the one to demand that something happens if maybe the regulators themselves or the government policy isn't also in step with, because you'll always have people or instances where they go, well, I'm not required to, I don't want to. Yes, okay, you have to then make a decision as to whether you then carry on with that client. But I do think for purposes of transparency and for the citizens of the world to actually understand who's doing what where, I think at that point there becomes a need for some regulation and some policy direction in terms of what is required. Otherwise, you do end up with benchmarks that are not comparable, and if anything, create a grey area where people can slide in and look like they are, but they're not, and we end up in the situation of more complexity as opposed to better clarity.
Okay, that's really helpful and very well made points. Let me turn to Martijn Rats, who's Morgan Stanley's global oil strategist. Great to have you with us, Martijn. You've spent your whole career tracking and analysing the rise and fall in fortunes of the oil and gas sector and particular stocks in the sector. Our pension funds have heavily relied on the dividends for decades of the oil and gas sector. But now more of those funds are pledging net zero by 2050 or even to halve portfolio emissions by 2030 in some cases. On the other hand, short-term energy demand is rebounding massively post-pandemic. So I just wanted to sort of draw you out on some of the kind of current picture, which is very interesting, but also to get your thoughts on which companies have the smartest business strategies in the sector at the moment. And secondly, are those strategies aligned with 1.5 degrees or frankly, miles off for the time being?
Yeah, well, you're hitting the nail on the head there when you mentioned the word demand. I think that holds the key. If you're a practitioner like I am, the thing that we are struggling with is not necessarily the very long run. As Lord Adair just mentioned, we know the energy system of the future that we need to build. Once we get there, that will be a stable equilibrium outcome. The future is quite clear, but the journey between now and there is quite a long one and may not be a smooth one. The thing that we're sort of mostly struggling, if you're in a seat like mine, is the relative pace of the supply decline versus the relative pace of the demand decline. And what strikes me about sort of all these discussions is that overwhelmingly we are discussing supply side measures. How can we reduce the thing of the fossil fuel industry so that effectively we produce less? But if you do that in isolation and not address the demand side at the same time, then frankly, that is not a recipe for a smooth energy transition. That is simply a recipe for energy shortage. So we also need to address the demand side in its own right. That's where all the scope 3 emissions are. If you're asking the question about what oil majors are doing, there are different stories to be told about European oil majors versus US oil majors. I think they're still, as of yet, on different track. But if you look at the European ones, which are the ones that I'm close to, they're doing a lot. They have all committed to being net zero by 2050, by and large on a full scope 3 basis. Now, scope 3 is difficult to address, but scope 1 and 2 are firmly in their control, and they have a lot to work with. They can reduce emissions from refineries and petrochemical plants and all sorts of infrastructure, and they're making a great headway. In terms of reducing scope 3 emissions, they clearly need help from governments, because scope 3 is all about demand. What oil companies can control is what happens on the supply side, but demand is more difficult for them to control.
And so, and do you? We have been talking about demand. We've been talking about steel. We've been talking about chemicals. We've been talking about a series of sectors that are very big users of energy. As you look at the pace and in those kind of major corporate users of the oil and gas sector's resources, do you see enough that really makes sense of the 1.5 degree net zero by 2050 commitment in the oil and gas sector, or is there basically a big disconnect still?
Yeah, no, like the difficulty is not necessarily the sort of technologies that are being put forward, the efforts that are made. They are very meaningful and they are significant. What I would argue is this problem so challenging, which I would argue is quite often under-discussed, is the rapid pace of energy consumption altogether. And it is very hard to grow the overall system whilst at the same time reduce oil and gas. And it's all a matter of relative scale here. So if you currently look at our primary energy consumption globally, it's about 600 exajoule every year. Depending a little bit on sort of how you account, but somewhere between 80 to 85% of primary energy supply is fossil fuels. That may not be desirable, but for now, that is what it is. You can then say, well, that gives us 20% of other things that we can work with. But the problem is that if you zoom in on the other 20%, what you'll find is there are three major components to that, which are difficult to scale. So out of the other 20% that is not fossil fuel, 17 points of that, nuclear, hydropower, and biomass. Now, nuclear is hard to. Over the next couple of years, we will probably shut down more old nuclear power stations than we will build. So that's hard to grow fast.
Yep.
Hydropower, 2/3 of the world's rivers that are suitable for dams already have dams in them. And they have ecological consequences too. And biomass quite often competes with food production for arable land. And that's also hard to scale. So the renewables that we're all excited about, where costs are coming down, where technological progress is made, is in the order of 2 to 3% of our primary energy supply. Yep. So if you're starting to think about, well, we have part of the system that accounts for something like 80%, and we need to shrink that. And the part that we can really only grow at the moment is just about sort of 2 or 3%. You have quite a bit of imbalance in that. And if you're trying to shift from 80% down to something that is 2 to 3% up, whilst the whole system is growing very fast, we're adding 1 billion people to the planet every 13 to 14 years. Yeah, then you might well end up in a situation where, frankly, we're in for a long time already, which is that oil and gas lose market share. And they are losing market share already quite rapidly. But the whole system grows so fast that actually the absolute volumes of consumption of fossil fuel isn't really that great. And it's the growth of the energy system at large that I think makes this problem so complicated.
Oh, it's an incredibly tricky, challenging, kind of grim picture you build, but absolutely. I want to just very, very quickly, before we come on to Ryan, ask you about the kind of green activist investors. A lot of high profile at Exxon, at Chevron, actually at Shell every year for a long time. What's your take on the impact that's having on corporate strategies? Briefly, so we've got time for Ryan.
It's having a real impact. Yeah, no, it's having a real impact. Admittedly, it's having a real impact already for some years, right? As in, look, we're talking about this now, but I would say that the real discussion around oil majors and decarbonization really started around COP21 already 5 years ago. In 2015, 16, this became a huge, huge discussion already. And over the years, this has been a major, major theme. And look, we all have a role to play, and there's clearly a role to play, for those, in society who say, look, there's a real problem. This is not good. It's not up to them to find the solutions, right? It's up to the companies and the governments at large to find solutions. They have an active role to play. They're playing it very effectively. Let me give you one data point that I think illustrates where we have already gotten to. In 2014, investment in oil and gas field development was $750 billion in that 1 year. That has been on a steady decline ever since. It took another nosedive last year. Last year, the oil and gas industry invested $350 billion, 350, in the development of oil and gas fields, less than half of just 5-6 years earlier. If you look at the net zero report from the IEA says that even in a net zero scenario, where oil demand is assumed to fall 30% over the balance of the decade, the appropriate level of investment by the oil and gas industry is $365 billion a year. So the oil industry's investment level has, by and large, on this metric, adjusted to a level that is, well, frankly, might already be a bit lower than what is required under net zero. The oil industry has adjusted a tremendous amount already. Now, there are many reasons for that, but the one that you highlight is clearly one of them. And so from that perspective, those pressures have played a role already.
Okay, that's fascinating and interesting to hear because ShareAction's deeply involved in that work. So look, let me turn finally to Ryan Panchadsaram. Ryan, you're a technologist and you've been a public servant in the White House, what sounded like an absolutely fascinating role. You're now in Silicon Valley. Silicon Valley, I want to ask you about what Silicon Valley has to contribute to this conundrum of the energy transition. My sense is that thinking in the Valley is kind of beginning to grapple with this, but it's not been a kind of serious or top theme for the venture capital community. So can you just talk us through what's the sort of level of interest and what's the contribution that you can see technologists and Silicon Valley investors making?
I mean, this conversation is all about financial risk. And when the role and power of innovation is it drives down costs, right? If we were having this conversation back in Paris, it's the hope and dream that solar and wind are going to be cheaper than coal and oil and other sources. And today it's true, right? In the next couple of years, it'll be actually competitive with on-demand power as well, too. So innovation is this powerful force. And so Silicon Valley, we believe in that. But one thing, too, that we believe in is transitions happen and you can't run away from them, right? Every technology company faces a transition every 5 to 12 years. The energy industry, it's in the 40 to 60 year timeframes. But what the greatest companies in the Valley and in the tech industry broadly do is they see a transition and they get ahead of it, right? Rewind back just 6 or 7 years ago in the oil and gas industry when they were rich with profits. That would have been the moment to jump on the bandwagon. But what you're seeing now is this burgeoning clean tech industry. You're seeing solar players, you're seeing wind players. And your real question was, what is the Valley really thinking about this as a category? And so I work at a venture fund called Kleiner Perkins. We were one of the pioneering venture investors in clean tech, but that was in the 1.0 wave. This 2.0 wave is really exciting. You know, back when Paris, everyone was here for Paris, you know, it was about $3 billion a year invested in clean tech venture capital. This year it's almost 30. This 10x excitement.
Wow.
I would say Silicon Valley is more of a concept than anything. Clean tech ventures come from all across the country, in Europe especially. There's a lot of investment in China and Asia. I would say it's about 50-50. You've got half of it going to North America and Europe, and then half of it going to Asia. But there is this belief there's opportunity here. You know, that 59 gigatons of emissions, that's a bit, every single ton of emissions is someone else's business model. And you know, when innovators see that, that looks like opportunity. And so we're just seeing so many new opportunities on the energy side, on the transportation side, on the food side. And I think what we have to see is just really cheering on these founders. And what we can see today, which is pretty exciting, is that you see proof of their work. If you stick by these founders at Sunrun, at Tesla, at Enphase, at Beyond Meat, you know, you just keep listing them. They are on the stock market. They're multi-billion-dollar, trillion-dollar companies. So that's what excites me, Catherine.
So, I mean, Martijn was talking about what actually a very small share of the overall global energy mix renewables are for the time being. But,
yes.
I mean, the idea of multiplying, times 10 just in a, 5 or 6 year period is very exciting. Can we maintain that pace? We need to maintain that kind of pace. Can we do so?
We need to, and I think we can. I mean, the neat part is, so, you know, Bill Gates has this concept of a green premium, right? As soon as, because, you know, it's the added cost of the green version versus the fossil fuel one. You know, for solar and wind, it's not a green premium anymore. It's a green discount. And as soon as something becomes a green discount, the banks, they'll fund it. You know, when it's not, you know, when it's still in that green premium stage, governments need to help and assist it. But truly, once something becomes a green discount, you know, that's the domino cost. Like, you just start to push it and things totally start to fly. And so I think the pace can absolutely happen because we're seeing this 20+% improvement every year on costs. So I'm on the optimist side.
Yeah,
I think I'm an optimist on the market forces side, yeah.
Martijn left me really depressed, and you've really cheered me up now.
But Martin's being real too. You know, I think my one piece to like the oil and gas industry is, you know, the Scope 3 emissions, those are your customers. So you can say that you're not responsible for them, but you look at the IEA report today, it showed oil trickling down and batteries trickling up. You should ride that wave. You know, there's a reason why Microsoft has been a durable company over the years. They did software, then they went onto the web, and now they're cloud services. Oil and gas companies need to think of themselves as energy companies, and they need to be thinking about delivering solutions to their customers. So that's just,
No,
that's me with the Silicon Valley hat on, though. That's the...
Let's just really briefly in the last few minutes talk about carbon tax, because, you know, that would push us from times 10 to, you know, that was potentially one of the massive amplifiers, is it not? Adair, do you want to just give some reflections on what that would do to, you know, accelerate these trends or shift the financing decisions, for a start, of multiple players with a stake in the energy system?
Well, I think the first thing to say is that carbon price is not the only policy tool. Sometimes regulation is more effective if you want to get people to change what goes on in their house. Probably best not to do it through a carbon price. You know, normal human beings, as against economists and business people, don't sit down of an evening with a spreadsheet and work out the net present value of alternative ways of heating their house. So in some places, regulation's better. But wherever you have professionally managed costs, and you have large costs from energy and carbon, a carbon price is a really powerful tool, and we need to use it. We, through what's called the Mission Possible Partnership, which is closely allied with the Energy Transition Commission, produced a report with the large slice of the global steel industry recently called the Net Zero Steel Initiative. And it described how we could get steel to net zero by 2050. And that if we simply let it work by replacing the plants when they came up to replacement, but no faster than that, we'd get maybe a 15% reduction by 2030. But if we had a serious carbon price by 2030, you could get a 35% reduction in emissions, even in this decade. Because professional managers of large input costs respond to prices. So yes, we ought to try and spread carbon prices as much across the world, in particular applying to precisely these hard-to-abate sectors, to cements, to steel, to chemicals. This is where we most need carbon prices. It is also true that that's where we hit the greatest complexity in terms of international competitiveness. Ideally, you want a carbon price across the world. If you don't have a carbon price across the world, I think you do have to go down the route of what's called a CBAM, a carbon border adjustment mechanism, as the EU it involves it, which is an interesting thing. It's one of the first taxes where the people who are imposing it don't want to receive the money, right? Because the idea is not that Europe wants to take that carbon price at the border on a steel input. They're saying, please, please introduce the carbon price back in Turkey, back in Russia, back in India, back in China, so that you get the revenue, not us. But I think carbon pricing is part of the way we have to go, in particular in these heavy industry-intensive, hard-to-abate sectors of the economy.
Okay, thank you so much. Look, that's all we've got time for. I can see the time ticking away. I really want to thank Martijn and Stuart and Ryan and Adair for a fantastic walk through the issues. And yeah, we're obviously here in Glasgow. We're hoping that the governments of the world are negotiating the carbon price we need. Let's see.